Hey, Mr. Duke.
Mr. Lorenz.
Sorry I missed you last week.
Well, would have preferred to be there, but oh well.
Guys,
Okay,
hey,
so I
Steve,
wasn't-
Brad, Joe, Jeff, we've got the band back together. How's everyone doing?
Okay.
Hey, Jeff, how are you, man?
Hey, I'm good, George. I love
Awesome.
I love the passcode.
Well, I figured no one in our demographic would forget it.
It took me a minute.
For those of you watching, it's 8675309. You're welcome. You're going to have the song in your head all day. Very cool. It's only 9:30 and it's already been a big day. There's Brad.
Here I am.
Hey, Brad, how are you, man? Good to see you. Hey, how was your event last week?
I wish I was there too.
No. How was your event?
Oh, my event. Oh, well, it was, I need to make sure that there are more senior leaders and owners really stipulate that in the group.
Got it. You ended up with what'd you end up with?
It was 14, I think. So
Great. Good for you. Very, very cool. Well, we had a ton of fun. We missed you, man. Next year, we had a ton of, I don't know, as Jeff might be able to attest, we had a good time.
Yeah, it was a great event, George. Really appreciate it. It's already my next year's already on my calendar, man.
Awesome. Thank you. Thank you. We're going to have fun next year. You know, one of the things I was, there were kind of, next year, the dates are set. It's the 29th and 30th of September and the 1st of October. And it's not all day for those 3 days. We tend to start at, after lunch on Monday and finish right at lunch on Wednesday. It allows people to travel. And we're literally already booking for next year. Will, in all likelihood, unless, it's theirs to lose, but the Mills House did a great job. And so we're going to be in the ballroom at the Mills House, not the long skinny room, the planner's suite. And we may use the planner's suite for breakouts, whatever. And we're talking to a couple of very cool venues to do a hosted group dinner. So imagine, all 70 of us, plus whatever spouses tag along, having dinner in one of two secret locations to be revealed once we get this nailed down. And bringing in more will be revealed. But one of the things we're talking about doing, guys, is, I also want to talk about C3D. But one of the things we have been challenged by you to offer is recordings, right? But when we record these sessions, it can change the complexion of the event. Now, we recorded my workshop at the BEI conference, and that went pretty well. You just lose a little audio from the room. But so I just don't want to kill the spontaneity, and it's bloody expensive. People they're like, oh my God, everybody in their brain is thinking that you can walk around with one of these and record the event. But these are 2 chip cameras and a professional videographer and a mixing board and. So it gets not cost prohibitive, but costly. So anyhow, something we're thinking about adding. So there was a fork in the road, or 2 options. One is to offer the recordings to participants. Great. The other is to allow people to participate remotely. Those of you who have been in the room, and I know, Jeff, you were freshly, Steve, Joe, you've been in the room. Guys, remotely is not going to be the same. We have a ton of fun. I mean, I'd love your comments.
So a couple of state associations I'm involved with, during COVID, they tried all that. And then really the cost benefit of recording just wasn't there for them. So they've stopped doing it.
Got it. Cool.
George, are you thinking about charging like a reduced fee for people who want to do the recordings, like 50?
No.
Come?
No, if you want to participate remotely, you're actually running my costs up. The cost will be exactly the same, whether you choose to be in the room or not. Your only savings would be on travel. I have a quote, and it's gonna whinge. I'm not gonna whine about it, but it's not insignificant. Whatever number you just thought of, you can probably double it because it's not insignificant. So no, there wouldn't be a reduced charge. And the other thing, Jeff, and to this point, as a policy, we want people in the room, right? What we did, right? What we just did last week in the room, you couldn't possibly do remote.
Yeah. I tend to agree that during COVID, we had to move a lot of stuff to, that was what it was. But now that we're back in person, I don't want to go back. And I don't think you could get that synergy at all be doing it remote. So I wouldn't go through the expense. I think you either show up in person or you just can't go. It wouldn't, I don't see the benefit of now. I just don't see the benefit there. I can't imagine somebody even would be willing to pay that to do it.
And that, my friend, is exactly why I'm asking you guys, whatever the community wants. I'm not going to hedge. I agree with you, Jeff. You will get value. You'll be able to listen in, but it's very different. You sat front of the class, right? It's very different when we're all together and deeply immersive. They're very participatory. And I warn everyone in advance, if you're not ready to roll up your sleeves and share, you probably won't get as much out. I mean, you don't have to, but anyway, it's a very immersive participatory event. So cool.
George,
and next year, Steve.
I agree with the comments, but I'll just, for the sake of argument, another ancillary thing you could consider that might be a benefit is you, as well as the briefers, could take those recordings and make some utility out of them for social media.
That is exactly what was Izzy's point this morning. She's already excited to do that. The other concern, and it's the concern's this big because we're seeing, we're experienced professionals. I just don't want to have anybody hesitate to share because they know that the recording is going to be amplified. Anyway, this kind of meshes nicely into our sprint. We are releasing C3D at the end of this month, the certification in the 3 dimensions of business growth. I'm terrifically excited because, I needed something more to do, but we're taking those of you who have been through the onboarding launch course, the old onboarding launch course, the big one, and I've been through the certification. We're taking those and we're creating a big C. I've always said small C. Now we're creating a big C certification, and that'll be and we're going to release that end of the month. We'll have our first live review sessions the week before Thanksgiving. So really jazzed. You'll be hearing a lot about that. I'm happy to answer any questions, but stay tuned. And
for the benefit of the recording, George, I invite you to explain a little bit more about that.
Well, Steve, I will read the, I did not pay Steve to say that. So I'll read the course intent. We have a statement of intent, which is that after completing this course, participants will possess key advisory expertise for growing private business strategic capacity across the 3 dimensions of business growth, delivering predictable profits, achieving sustainable growth, and maximizing transferable business value. And certification is earned by demonstrating the ability to develop and implement strategies in these key areas, enabling clients to realize their strategic intent and achieve long-term wins. And so it's not certification in clarity, right? It's certification in the 3 dimensions of growth. We are going to, the course journey is an engagement journey. And we start with working with COIs, the growth conversation, and we go through, the best case process. CEO clarity, team clarity, getting the team to create a consensus view of the business, taking that consensus view, what skills do we need to take that consensus view and turn it into a strategic plan, one in which everyone is emotionally and professionally invested, aligned, accountable, and then how do we deploy it? And so while we'll touch on a few tools, the real concept is to focus in on the 3 dimensions of growth and how we would deploy those to meet those 3 CEO goals, right? We know that CEOs want it 62% of the time they want to grow, 21% want to make their business easier to run, and 17% are preparing to sell, are preparing to exit. It's going to be that's the course journey, and the format is online, 16 hours plus, so 16 classes plus 4 review sessions that are up to 2 hours each, and then an exam. And I will be on every video, but much more importantly, guys, I'm there as the chaperone, if you will, on most of this. And we will be hearing from your colleagues, right? And It's very different than anything that is available in the market right now. And we'll make it the best that we can. I'm terrifically excited. The amount of feedback that people signing up, getting onto the interest list is significant. So our first cohort's going to be it's going to be cool. We'll have some fun. Who joined us? Ed Wonke. Hey Ed, how are you?
Hey, good morning. You feeling better?
I feel great. Yeah. So guys, last week, so because this is how life works, right? We had our conference. So there's the run up to the conference and the conference. It was a ton of fun, a lot of work. That's okay. Then on Thursday, I had to have oral surgery. And on Friday, we had Helene. Just what a week.
Yeah, I could say that was a blast and a half, right?
Yeah. So.
Yeah, because I drove from Charlotte to London, Kentucky on Thursday, and then I drove from London, Kentucky to Ohio on Friday, and I was in rain for 6.5 hours each day.
Yeah. But I'm happy you got home safe and sound. I'm sorry you didn't get to see your nephew or grandkid.
Yeah, it was my nephew, but I did see the granddaughter, so that was the important thing.
Great. Very cool. All right, guys, I've just spent 14 minutes. I've just taken 14 minutes of airtime. Hey, Jeff, I saw that you posted that you're looking for a Section 409A valuation.
Yep.
Care to comment? It's that easy.
I mean, look, over the past, I don't know, decade or so, I've probably outbound. I can't even begin to count how many valuation opportunities, whether it's pay or gifting or whatever, to valuation firms, companies, and never really had any synergy with any of those firms. So, I'm trying to get deeper connected with this group. So I know there's some valuation folks in the mix. So
you're looking at one of them.
yeah, like we sat at the same table. If you're interested, drop me an email. If you do some work, I got another, from the time I put that up to the time I got on this call, I had another client reach out and ask me for the same thing. So if you're interested, let's connect after this.
Okay.
Yeah, Ed.
I don't do that. I don't do valuation.
No, Ed's great. Ed just did 5. I'm just catching my breath on Ed's behalf. Ed just did, what was that? That was like 2-3 weeks ago. Ed finished up. He had a sprint of 5 or maybe 5 sprints.
Yeah.
5 valuation.
5 valuation cases.
Yeah, you've been busy. That's great.
Great.
Well, I'll leave it between you gentlemen.
Perfect.
And that's very cool. We have a lot of valuators in the community, and that's great. Thank you, Jeff.
Yeah.
Let's work. We work together. And if Ed's a bad collaborator, you feel free to out him.
I'll keep that in mind.
I have a feeling there's a low chance of that happening.
Hey, George, I'm sure you covered this last week, but the report is finally out, right?
It is.
Okay.
Yeah, guys, if you look at the level 1 report, the only thing, it's probably there. I haven't checked this morning, but they're adding the page numbers. We tried to make those dynamic. We're adding the page numbers. And well, Steve, so that's, if you have not seen it, ladies and gentlemen, it's this report. We've been teasing it for a while, and it's 23 pages of really good education for your clients, right? How do we help them? How do we help them understand why strategic capacity is important, the value of their business, and the impact that strategic capacity has on their ability to monetize that value? And it's really an education piece. And it is designed to have several places for you to hang your hat, no matter, which one of our customer professions you happen to be, whether you're a management consultant or a business coach, a CPA, an exit planning wealth advisor, an investment banker, a fractional CFO. There are a lot this is a really deep, it's a good conversation. And we'll follow it up with the continuity. I will have the pre-release version of continuity this week. I don't have any updates this morning, but they've promised it this week. So we should be able to release that sort of in the next week or two. Continuity is, of course, the tool for looking at the risks outside the business. For example, I buy a huge piece of machinery, I invest hundreds of thousands, potentially millions of dollars in that machinery. I take a loan. Often it's my credit or even my family home that's, as an entrepreneur, that's on that beast. If I get hit by a bus, who's going to pay that off? There's insurance for that. Well, a lot of business owners haven't really thought that through. Or the equity value planner tells you that you need to have $21 million under management and you have a $3 million life insurance policy. We need to have that conversation. Now, as business advisors, we're not going to help with that. But what we do have are COIs in this community, wealth and insurance advisors in this community, or maybe you have them in your network. They need not be in this community, with whom you can say, hey, man, hey, hey, Jane, I've got this continuity analysis from John Doe, and take a peek at this. He's happy to have a sit down. I have challenged the community and will continue to challenge the community to start conversations with business owners about whether or not they're getting the full range of wealth planning and insurance advice that they should be. And how do we start referring? We have our hand out to COIs all the time saying, hey, hi, I love you. I'd love to talk to your clients. How do we give back? We need to make this much more of a two-way street. Will it ever be one-to-one? I don't know, but that's a goal. It's a goal for us to have. So continuity is coming out, and I'm excited.
George, how many questions are associated with that?
Continuity is about, it's 15 questions plus 3 general, hey, equity value planner said you need 21 million. How much do you have? And then it just calculates the gap, the insurance gap. So it's 15 questions in 3 categories, plus those 3 sufficiency questions.
I was toying with developing my own one of those, but if you're doing that, then perhaps I won't.
Well, take a peek at what we've got, and if it works, Steve, it'll be included in level 1.
Okay.
So it's part of the level 1 suite.
Another one of my naive questions, but no pun intended. For clarity, lead gen doesn't create the new fancy report, right? It's the other link, correct?
That's correct. Lead gen is a free account, and it's free now and free forever. And when we have a lot, scores and scores and scores. We're not in the hundreds yet, but it's growing of people using that freemium. And I'd be happy to talk about that, but that's free. For those of you who are investing in being members of this community, there's a lot of additional value. And so that's, Steve, it's not in level 1.
Mm-hmm.
Okay. I mean, it's in level 1, it's not in the freemium.
Yeah. Thank you.
Wow, you just see. And then after we do continuity, we will have we're going to release sort of 3 other reports. One is the level 2 report, which you can think of conceptually as the level 1 report plus the insights from level 2, and simulator, which you guys loved, man. We showed it off. We ran it around the track in the room, and people are loving simulator. We get a couple of months of usage data. I'm going to be fascinated to see that data. And the leadership system. So because we're lazy here at Growth Drive, you'll also see a series of webinars. We're meeting it, and I'm signing off on the calendar here this afternoon on a series of webinars that are going to be specific overview, sliding into training a little bit, webinars on a lot of these modules, the new report, continuity, leadership, and simulator. There's a lot going on. That's why I get up at 4:00 in the morning, having a ball, man. I got to tell you. So does that all make sense, guys?
Mm-hmm.
Mhm.
Yep.
Yeah. And we're, as I've said, we have the hull of the ship. We have the hull of the ship, and this is a business advisory community. Being a member of this community has value in several different areas. The value is in the community. Let's take Jeff saying, hey, I need a 409A valuation. Who do I know, like, and trust, with whom I have a relationship, et cetera, or, all the questions that we see going on behind the scenes between you guys. It's fabulous. You also have the clarity tools. And then you have our knowledge base, which, is as simple as the onboarding launch course, which is, I know I'm using an old term for a new course. It's 6 classes, about a half hour each on, here's how you turn it on. Here's how you use it. Here's how you discuss it with your clients. So it's a, pretty high level sort of 101 training, and that includes some coaching. to the mastermind peer group. We're adding members there, guys, and C3D. So there's one thing that you challenged. Jeff was in the room, Ed was in the room. One thing that the community has challenged us with doing is creating a DCF calculation of value. So how do we take another look at value? And what conversations, I always think in those terms, right? What conversations does the conversation around the DCF value of the business drive? So imagine right now we have your value at top strategic capacity. It's a market view. Your value at current strategic capacity, market view, and the value gap. And those are great, right? Those are super accurate and especially relevant. That's the highest bar. That's a third-party sale. Okay, well, if we're going to do an internal transfer, often the price of the business is dictated by the available cash flow. So how do we lead a conversation about the impact, the relationship between DCF and the achievable, the sustainable sale price of the business? And if you think about an internal transfer through the lens of the 3 dimensions of growth, right? Imagine I am selling growth drive to my kids, right? This happens out in the world all the time. The kids don't have any money to pay me. I need to retire. Where's the money going to come from? Well, it's coming from the oil well. How do we make sure that we have predictable profits and cash flow, and that I, as a retiree, have the metrics to look at to be like, all right, I don't have to panic. I don't have to come back, right? Predictable profits and cash flow, sustainable growth, which just eases the debt load over time, and then maximize transferable value, which really goes into, I'll just leave that topic alone. It's highly relevant, but we could talk for the next hour. Does that all make sense, guys? So DCF, we would have, now let's look at the value of your cash discounted back.
Yeah, I mean, DCF is an income approach.
Yes.
So, you're now looking at how effective are they operating the business. And I think that the best part of that is when you factor in company specific risk. And, we can gather that off of the first level of assessment.
I love you, Ed. I do.
But
so you're exactly right. So let's take DCF. DCF has just for those of you out here who the uninitiated, when you do a discounted cash flow, there's obviously a discount rate. And a lot of tools out there use a slug. They're like, okay, it's we're going to discount the cash 14%. Okay, cool. I'm gonna leave that topic off. That's a podcast. But strategic capacity infers a discount rate, right? We can extrapolate a discount rate from strategic capacity. So we have our market value at top strategic, our transferable value at current strategic. We have DCF. We have DCF at a market prevalent discount rate.
Right.
They're out there. And at strategic capacity. What would your DCF look like if we start blurring the lines and say, okay, well, imagine that we've taken your DCF through due diligence, and now I'm coming back, because this happens, guys. These are the looks. And then we have the asset value of the business and the liquidation value of the business. Now look at all those looks at value and this rich conversation we can have with our client, especially that 17%. The reason we haven't done it earlier is right now we're talking about maximizing the value of the asset, but 83% of CEOs aren't thinking about monetizing, right?
Right.
Well, how do we better serve those who are, and how do we help them understand? Well, here's what it would look like if you do the hard work to be able to sell to a third party. Here's what it looks like if you want to do an internal transfer to whoever internally, your kid, your employees, a group of employees, etc. What does that look like? I'm excited.
George.
Yes.
Does that imply that, or can I infer that you're somehow going to require a hookup to an accounting system or manual input of accounting data?
We could buy DCF data based on the NAICS codes generally, because NAICS codes are going to dictate company specific risk and size risk automatically. And that's doable item from a couple of the people that provide that data.
Yes.
And it's automatically adjusted for prime federal rates.
Tie it back to the specific cash flow of the business.
Yeah, Ed, you're absolutely right. And these both go to answering Steve's question. Yes, we have We have an API framework. Yes, it's SOC 2. Yes, we are connecting to outside systems. And yes, my initial design request for the DCF is to bring the financial data in via API. Okay. I am not committing to doing that in Rev 1 of the DCF calculator. However, that is in our design. That is in our design timeline. And the API, the API exists. It's investing in the interface, and making sure we get this right. And then everyone on this call knows to ask, what is the quality of the data we'd be importing? And then we can discuss as a community, are we better off sitting with our client and their controllers, CFO, CPA, and talking through the 3 years of numbers? Or are we better off, and think about the client experience, right? Or are we better off hitting the magic button? The reason that Biz Equity and Capitalize are running around going, hey, we automatically connect to QuickBooks, is because it's such a pain in the tuchus to input all of the data that they need to run their calculator. Well, we don't have that problem anyway. So that's where my brain is. But Steve, heck yes, we are not an island, or we are an island. What's the best analogy? We're Venice, right? Mm-hmm. We are an island. Big, beautiful island with lots of beautiful restaurants. You're gonna like it here. But we are a trading nation, right? And we are going to we're going to pull from and feed other systems. And that architecture is built. It makes sense? But think about the client experience. Right now, you're going to do use Biz Equity or Capitalize, I don't care. But let's pick on our friends at Biz Equity. Great tool. The user experience is, I'm the CEO, and you say, hey, George, I'm going to calculate the value of your business. I need 3 years of tax returns. I need 3 years of financials, the tax returns. And I say, oh, here you go, Steve. Here are 3 years of numbers. And I go about my business. And you come back sometime later and you say, hey, George, I've got your valuation and your business is worth 18 million. And I say, Steve, how can that be? My business is worth 30 million. That's one user experience. That's the Biz Equity user experience, the Capitalize user experience. A very different user experience than what we do, which is to sit down and say, hey, man, if I have your gross and net, and now we're going to look at the quality, the strategic capacity of your business and talk about how that we would expect that to impact it, what the market has rewarded and what the market has discounted. And you are participating. You are I as the client am actively sharing my perspective on the business. It is a very, very different user experiences, and ours is proving to be profoundly more valuable for the client, right? Because we can't really tell them what to do. I always use this analogy. Who has kids? You want to get your kids to, you want to get your kid to mow the lawn, you have two choices. This is what I found, at least. I have 3 boys. I can say, hey, man, why don't you go mow the lawn? That's going to be one response, even though they know I'm going to give them, I'm going to way overpay. The other is, hey, man, I know you're going out on Saturday night, and I was just, if you needed a little extra money, I got a couple of jobs that need doing. One of them is, for example, mowing the lawn. So let me know. And that lawn is going to be mowed before I get back inside the house. So how do we create that second experience for our clients? All right, I'm on a roll this morning. I haven't even had that much coffee. Does that all make sense, guys? Okay. Steve, questions, comments? I see the wry smile.
Well, what you're about to do is fraught with some challenges. That's all I'll say.
It is.
But I think, Steve, from a practical point of view, from a valuation, when we do a business valuation, for tax gifting or estate type of thing, we have to look at the income and the market approaches to valuation. And classic, I'm looking at one right now where we've got the market for the land and the income approach for the farm. And it turns out that the farm cannot generate enough income to be anywhere near the market value of the land. And so if I had every ounce of the land yielding the same amount per acre, when you have, a little over 2,200 acres, I've got a market value of $58 million. Can you know what kind of yield I got to have on corn and soybean in order to generate a $58 million on an income approach for that land? It can't happen. You default to an asset approach with a market value of the real estate because the real estate has got so much more value than in its current usage.
Yeah. Well, I'm not arguing with the merit of the idea. I use some financial analysis software that calculates a DCF and 6 other methods of valuation. And under that umbrella is asset and market and income. So I 100% agree with the desirability of it.
So, and Steve, to your point, and we have a very focused design vision, right? Or mission. This is a business advisory tool. And I know the tools that you use, and they're excellent. They are top flight. And so if we're in CEO speak, we are going to stay in CEO speak. So our DCF calculator is not a CFO, is not CFO centric. It leans into CFO land, but we're trying to have for planning purposes, all right? We want to have additional looks at value. I'm the one who always says value is mildly interesting, right? The value we calculate is mildly interesting. Strategic capacity is fascinating. Mm-hmm. That's the strategic capacity is the thing. Value is the output of the thing, right? Strategic capacity drives value. So, and strategic capacity drives value no matter whether you're looking at market or DCF. Now, asset, that's a different animal. But Steve, we're not going to lean into CFO land. So things like the excellent tool of VFD Pro, right? Which know and love. That's a CFO, from my perspective, a CFO tool that, for example, well, Jeff may use it, but Joe will probably never use VFD Pro. Brad will probably never use VFD Pro. He might bring in a fractional CFO or you to run VFD Pro. And now we're adding additional. Paint by numbers, you paint all the low numbers first. So paint by numbers, we're busy painting the higher numbers. Bring that CFO perspective. Keeping in mind that if you look at the leadership module, guys, and where we take the 24 growth driving objectives and assign or allocate primary accountability across 4 executive areas, the CEO and the CFO both have 7 growth driving objectives. They're different, right? Primary accountability. The CFO is an insanely important role, especially as businesses move up the demographic, the revenue scale. Mm-hmm. I'm on a tear. Jeff, what do you think?
Sorry, George, I got distracted when I texted.
Oh, okay. I'm sorry, I didn't mean to put you on the spot.
No. I just got majorly distracted. The person texted me 3 times. Please answer.
I'm going to rely on CFO.
Yeah.
George, just to get in the weeds, are you planning on fiddling around with add backs?
I would say that we probably shouldn't, because I don't believe that that's where most business owners would think about. And instead you have to verbalize that to them and ask the basic question, how many personal expenses are you running through the business? But I think when we're looking at some, $15-20 million revenue type of companies, you don't see as many of those type of items running through because they recognize they don't need to, and they don't do it. I think you tend to see it more often on the smaller size businesses.
George would know this better than me, but I think there's going to be a larger percentage of smaller businesses analyzed than $25-30 million businesses.
And that's just statistically
Correct.
Statistical reality. So Steve, and we're gonna with these conversations, by the way, when we were in the summit, I asked people to put up their hands if they had made a suggestion and seen it. She'd seen it, 2 weeks later in the software. A bunch of hands in the room went up. Steve, so that will continue to be the case. We have a community centric. It's not crowdsourced, and it's definitely not a committee. But I get your feedback. So Steve, let's talk about that point. what do we want to, let's take a $5 million gross annual revenue business, right? So between Main Street, it's pre-middle market. What conversation do I want to have let's relate it to value, right? What conversation do I want to be having with my client as regards value? And one of the things that they may be doing, maybe, guys, please feedback. We hate paying taxes. We want to pay the minimum possible at law, right? Fair. That perspective can actually depress a market calculation of value, right? Because you take a manufacturing business where value is calculated based on net income or EBITDA, and I'm working very hard to make sure there's no EBITDA. Now suddenly we're having a conversation like, Steve, we did 15 million last year, or we did 5 million. What do you mean my business is worth nothing? You're like, well, dude, that's how the market's going to look at it. We need to talk about adding back. So that would be my, again, not leaning into CFO land, but starting the conversation around, it's interesting. It's almost an extension of the, hey, if I'm so profitable, why am I broke? Right? If I'm living a great life, what do you mean my business has no value? Well, how much would the market pay you to do your job? I don't think the market would pay you $500,000 a year. It's a $5 million business.
George,
Steve,
George, on a business like that, I mean, how would you even go to market without fixing up those financials first? I mean, I don't mean to
You're 100% right, Jeff. And that's the conversation. And as we discussed at the summit, let's have 3 years or more of clean books.
Yeah, but so if you're talking about so I'm just thinking this through, I'm kind of thinking out loud here. So if I was to run that through any sort of modeling system, I wouldn't even attempt to do that without having adjusted financials, because you're right, it would show a value that was so ridiculously low the client would throw me out of their office. I mean, seriously, they would yeah, your company's worth nothing. Here's a check for $5.
I don't mean to laugh, but yeah.
I'm serious. I mean,
I totally.
I mean, for what it's worth, I always tell people I always tell people that, look, if your tax advisor has been doing a good job all of these years, right? Your business is worth basically nothing today if you go to market as things stand. So the job day one is to take those financials and stand them on their head because they're tax financials. And now we need to do the exact opposite of what you've been looking at all these years and make it look super bad for tax purposes. I mean, that's oversimplification language, but that's basically how I laid out for people, which I'm sure everybody on this call already understands, but that's step one, day one to valuation 101 conversation for them, right? We got to take your tax reporting and throw it out the window and stand it on its head. Because you can't go to, it's the whole reason why you can't take an unsolicited offer and just throw your QuickBooks over to the buyer.
And that goes to, you saw me kind of dancing around the QuickBooks API. That's exactly it, because it's garbage. We always say garbage in, garbage out. And Jeff, you are a tax expert on the national level, right? You are, ladies and gentlemen, Jeff Getty, as sharp on taxes as anyone out there. And your point's a really good one, right? And it's like, I know I told you to do it this way. I mean, you may not be the person who is telling them, giving one set of advice and then shifting gears, but often we end up getting handed a package, right? A case. And we have to say, yeah, you were getting great tax advice and it's terrible advice for selling your business. Yeah.
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 It just for the record, George, as you know, occasionally I like to chirp. So I'm just chirping. I'm not dumping on any of your ideas here. I'm just chirping.
Oh my God, Stephen, you and I will have sidebar conversations, as I will with many people. Yeah. That's why we have these conversations and we're doing it publicly. We're transparent. Anybody wants to join this conversation, come on in. The water is more than warm. Someone will hand you a beer. We have a good time. Somebody get that man a cup of coffee. I appreciate your chirping. Again, this is about you guys. How do we best help you guys? How do we help you? If we're going to solve this market's problem, we need our clients to engage. We don't need our clients to toss us out of their office, which they'll do, right? If they don't understand the context for the advice.
But I think, George, you hit it on the head, though. I think the clarity of presenting it to the owner of the business has got to be simple enough that they could grasp what we're talking about, and it cannot be mirrored in CFO talk and a lot of complex information. And I mean, Jeff and I could both talk in complex business valuation when we've done things for clients. The trouble with it, though, is that as soon as they talking about minority discount, marketability discount, what do those mean? How do they come about? We're into an esoteric discussion on things that they don't need to worry about. All we say is that if you are a minority shareholder, it's not worth as much as a majority shareholder. Stop.
Yeah. Yeah, we can't talk over their heads. You know, one of the things that we shared at the summit was AI, and we have a prompt for this report as well, but AI for the level 2 report to turn it into the level 2 report currently is 72 pages. There's a lot of great information in there, but it needs to be digested, right? We need to chew it up. We need to present it to the client. And we have prompts that we share. They're in Circle, guys. They're in the AI area, space in Circle, in the community, that you can use for taking that 72-page deep dive, and soon to take this 23-page initial and to put it into a 1-pager or a 2-pager for the client so that they can bullet point this thing and we can lead a concentrated conversation. And Ed, your point's a great one. We can't talk. Nobody likes to have talked over their head, especially the person writing the $20,000 check, right? And this may seem, and Brad, maybe you've experienced this. You sit down with the 3 financial statements with a typical CEO, and what's their reaction to that stack of numbers on the table? I know what my reaction was. I know what
From the report.
Yeah.
Yes.
That's all fine and good, Brad. How the hell are we going to grow revenue?
Right. And most folks understand, as Joe was saying, that they run their business to break even and don't really think about sales, selling the product. Yeah,
that's right. Another wide-ranging conversation. What else?
I have a
Thank you, Brad.
different subject, but all related. So I had 2 business owners tell me recently they didn't have to worry about exit planning because they're going to transfer their business to their kids. So you could read that a number of ways. The cynical way is, okay, I'm going to give it to the kids or sell it to the kids, like transfer a bucket of crap to them. I don't have to worry about making it a good business.
Yeah.
I don't know why owners don't. Anyway, it is what it is.
Any comments on that, guys? Yeah.
I'm involved with one right now, and I met with him when I was in Charleston, because that's where the company is located. And I told them that their current business performance is crap and that there's no way the son could afford to buy the business in the current state. If they can't clean up what they're doing, there's nothing to transfer. And the owner looked at me and said, what do I need to do? And I told him exactly what some courses of action. He says, could you give me a guidance to somebody? I had dinner that night with a person that could go in and help them. And on Thursday, they were already together after I met with them on Wednesday. So, I mean, it's that kind of thing that when you tell a person the honest thing that they have not been willing to face, most owners say, well, then what do I have to do, or who do I need to talk to so I can fix this? Whatever it is.
And I'd love your comments on this. Even as we move up market, or we move into larger revenue businesses, if I'm running a $50 million business and I want to, and maybe, there are a bunch of questions, right? Do I need to sell it to my kids, or do I just need to transfer it to my kids? If I transfer it to my kids, Jeff, tax implications, etc., planning way in advance. And if I need my kids to take a note that's paid for out of cash flow, and now we move straight into caring deeply about predictable profits and cash flow, and probably de-risking that revenue stream by creating predictable, sustainable growth. Not this, just good, faster than inflation growth. And that I in retirement am not looking over my shoulder or, heaven forbid, micromanaging. I want my kids to be successful. And we all want our kids to be successful, right? I've never transferred a business to my kids, but I would imagine that it might be even more so because I'm taking something that I view, we don't talk about this enough, something that I view through a similar emotional lens than I view my kids, right? I had the idea, I wrote the idea down, I turned the idea into a plan, I tucked the plan under my arm, I went to family and friends, to banks, I got money, I worked my butt off, I think about this thing 24 hours a day. It's the same as when my kids were in school, in grades and sports and behavior and developing into be good humans. We have this immense emotional investment, this thought investment, this caring investment in this business. And we're going to care deeply about the business. We care about as a business owner, our stakeholders. A lot of people, again, I talk about this all the time, but if you don't think in my manufacturing business, and I had to shut it down, which was terrible. Didn't matter that I went, I ended up divorced, personal bankruptcy. I lost everything and then some. But that wasn't the worst thing that happened. The worst thing that happened was picking up the phone and calling. They were all men, but there was a woman. They're calling Sharon and the guys who made substantially all of their income from my business, right, as my prime vendors, and telling them that the train had just run off the cliff. We just done Cassandra's Crossing, right? And our emotional investment, our emotional relationship with our stakeholders, vendors, distributors, suppliers, is huge. All of that goes into the mix about this business that I'm now going to give to the people I do care about the most in the world, my kids. Got a little bit of a tear there. But I don't know what's up with me this morning. I apologize, guys. I got the talkies. But it's, these are hugely emotional issues. I was talking to Eric Owen this morning, and we were talking about how complicated it is when we get into these conversations, as we talked about at the summit, because when we get into transfer, there's the professional considerations, there's personal wealth, there's professional performance, and there's also this huge emotional, and maybe, the iceberg under the water, that picture. The emotion is big.
In exit planning, of course, that's one of the first things you need to check is what the business owner's motivations are, what their aspirations, desires, etc.
In every conversation, Steve, I totally agree. That's why we have the growth conversation.
Yeah.
Where does this story go? What does it need to deliver for you and your family?
There's the one that you just talked about. You're deeply invested in the business and care about its future and blah, blah, blah. I've got a business for sale now, and I've got two potential buyers. One is essentially a PE firm, and the other is, an individual. And I asked the owner, I said, "Do you have a preference?" And he said, "Nope, just get me out of here."
Give me a check. Yeah.
I oftentimes try to describe what they're driving to, running to versus running from. And that's going to be a lot better on keeping them feet to the fire. We just had a meeting with a capital group this morning, Ed and I, and that's basically messaging around, why things drop out and, trying to encourage them to get part of the 24% club that actually do the deal. And so much of it is that the owner it's not about the money, guys. And we keep on coming back to wanting to close the gap and talk money, but it's not about the money. It's actually far from it. And so, we got to stay emotionally connected to them and understand some of their longer range goals. And oftentimes, George, it's better for the owner to sell it and let Junior, blow $1 million versus blowing, 30 or 40 or whatever dollar amount the business is worth, and some owners don't see that, but yeah.
Well, who is it in the community, Joe? You're making a very good point. Who is it in the community where the owner thought he was going to transfer the business to his two sons? Is it someone on this call? And he decided at the end of the day, he's like, you know what? I'm going to keep running the business, but I'm going to create an investment pool for each of you, and you go out and you create the businesses that you want, and I'm going to help you do that. And it's a really interesting case.
I got a client that's doing that very thing right now, and one son wants to be the financial advisor, another guy wants to open a soccer training facility in Nashville. And
Isn't it Nashville?
Oh,
Nashville, yeah, not
Sorry.
Asheville,
Nashville.
no, Nashville. But anyways, so fully recognizing that this is our dream, not their dream. And why do we feel in the auto dealer industry, it's wrought with that kind of legacy, complicated issues, and God love them that they're willing to carry on the family brand. But Mark Wahlberg in Columbus bought one of the local dealerships here, and the last family member standing felt so responsible because he was feeding the rest of the flock, but they weren't involved in the business at all. But they were, making money off the maturity of the business. So there's just a lot of weight on that second, third generation to feed the family fortune, and we call it a family tax. And so it's good to not have that social, that Damocles over the top of your head,
Damocles, that's right. Hey guys, Joe, thank you. You're right. Every business is a family business, but family businesses, formally are a thing. Yeah, I got to jump as well. It's 10:30, guys. Listen, thank you. Thank you, Ed, Jeff, Joe, Brad, Steve. Really appreciate it. And anything I can do to help you guys, let me know. You have a great week.
Thanks, everybody.
Thanks, guys. I'll see you soon. Bye.